For those of you guys that are watching this Shares to Buy Today video for the very first time, I've started a stock market investment series, guys, where each month I talk about a stock that I can see being a good investment in the future. This month, Shares to Buy Today, December 2020, is all about WEY Education PLC. But it's got a little bit of a twist, guys, because most of the other stocks I've talked about in the past, I can always see them growing long term. But this stock right here, I think can especially benefit from the short to medium term period, guys. But find out why later on in this video. Oh, and don't forget to like this video, share it too, and subscribe with the notification bell on if you haven't done so already. It's you guys doing those things there that lets me know that I'm making a difference out there, which is what this channel is all about, guys. So referring back to WEY Education, as the name suggests, they're educational stock. In particular, what they do though is they offer interactive and engaging educational material online to young learners from the comforts of their home. And I know you guys can probably tell where I'm going with this, because with the way things are with the current coronavirus pandemic, it has shown us, guys, how invaluable online education is right now, especially with the fact that schools are closing down and teaching has had to occur online. All of this has driven demand up for stocks like WEY Education, with a current share price at this time of recording of 28 pence per share. But when you look at the share price movement, guys, you'll see that the graph has risen almost perfectly in line with the point at which coronavirus started, guys. It's not a coincidence. This is why I see this stock benefiting in the short term, especially almost in line with the current coronavirus pandemic. But as much as I'm rooting for them now, they're also limiting themselves, guys. They're only offering their services to young learners. But what about the adult learners? If they branched out like that, they could be creating another avenue to generate wealth for themselves. But heck, this could be the very next thing that they're looking to do. One thing that might be a bit alarming is this stock's P ratio. It is high, guys. It's around 46, heavily indicating that this stock is overvalued. But when you look at the financials deeper, it makes you understand things better. First, starting off with the income statement, as you guys can tell, the revenues have increased throughout the years. Always a good sign to see, but unfortunately the costs have too, guys. And it's only been this year that they've actually made a profit. All the other years they've made a loss, with this year equating to around £870,000, guys, after all of the expenses and taxes have been deducted. I believe this is the real reason why you see such a high PE ratio and it seems overvalued. It's because the stock only recently came on the stock market about 5 years ago. Hence, they only make a profit right now, guys. So it's less of the stock being overvalued and more of the stock being on the brink of a change for the better. But let me show you the best part in the balance sheet. You can see from this financial document right here that they've got enough in just current assets alone to cover their total liabilities, guys. I really like what I'm seeing, because any doubts that you might have had, guys, of this stock going into bankruptcy, which is a big fear for a stock of its size, especially with the fact that they're only making a profit this year, get straight away suppressed, guys, because they've got so much immediate cash to bail them out. And the icing on the cake is right here, guys. They've got £6.51 million, majority of their assets in cash and short-term investments. So they've got highly liquid money if they ever need to call upon it. But will it be a similar story in the cash flow statement? After looking at it, I'm glad to see that the net operating activities had the general trend upwards, guys. Yes, in 2018 they made a loss, but when you look at the grand scheme of things, very foundation this business was built upon, make them a profit at the end of the year. Every investor wants to see that, guys. But when you flick over to net investment activities, it's a little bit of a different story. It fluctuates massively, guys, but generally speaking, it is negative. This Shares to Buy Today, WEY Education, show a willingness to invest their money and desire to grow. But when you look at the net financing activities, it's been positive throughout the years, guys. This isn't a good look to have, because it shows that this stock is borrowing more and more money from their borrowers, and they're also using more money from their investors. Why don't they have their own money? But it's all about context. When you actually consider that this is a fairly new stock in the stock market, they only came in December 2015. And you consider the fact that why do stocks even enter the stock market? It's actually to have more access to more finances from investors. You can take into consideration why these values are positive. But what I will say though is that they can't cling on to this excuse for much longer. As they start to find their feet in the stock market, they've got to start making these values more negative and start paying back some of their investors and borrowers. Altogether, these shares to buy today in the WEY Education stock, I can see them making a lot of investors a lot of money, especially in the short term because of the increased demand for online education. But I do have my reservations, guys. The very first one is that it's in the AIM market as opposed to the heavily regulated FTSE indices, so there is a threat that as this stock grows, and it looks to enter into these bigger FTSE indices, it might struggle to follow their more stringent rules. And the second point is that it's got a relatively low volume compared to most of the other common stocks that you're probably looking at, in the bigger FTSE 100 and 250 groups, meaning that it's probably going to have a bigger spread and also it's going to be less liquid. So it might take you longer to buy and sell in that stock compared to most of the common other ones. But then there's the question, does all of this even matter in the very first place if you're onto a winner stock? I'll let you guys decide down in the comment box below on these shares to buy today in December 2020. Before I end things here though, I need your support on YouTube. I need you guys to smash that like button, share it too, and subscribe and the notification bell on if you haven't done so already. It's your favorite YouTuber, guys, DS Learning Finance, sharing my thoughts and my experiences with you guys every Sunday at 3 p.m. Have a good day, people. Bye.
Whoa.